Good morning and welcome back to Margin. This morning we're going to talk about how to pay off debt by driving your car. So let's jump right into it. So when looking at your personal finances, you're always going to want to look at a holistic point of view. You're going to want to take into consideration all of the components of your financial picture to figure out what things need to be adjusted. One of which is buying a vehicle with margin and being able to build margin into your finances through transportation. So how I look at this is typically from one perspective or another, in the sense of having two different options that typically are recommended when it comes to people building margin utilizing transportation methods. So when looking at how building margin into your transportation will actually affect your debt and your unsecured debt, you're going to first and foremost want to look at what you have the highest balance on, then at what you have the highest interest on. So you may have a credit card that has 17% interest. You may have a line of credit with 11% interest, or a loan that you have 9% interest on. But you want to look at what those high balance, high percentage rate loans look like, so that then you can figure out what order to pay things off in. So as we go through these themes related to building margin into your personal finances, I'm always going to be recommending that you strategically look at your personal finances from a holistic point of view, looking at from a point of view that takes in all the considerations at play to make sure that you're building margin in and you're not inadvertently not giving yourself any breathing room. And so I always look at it from the standpoint of building in options. And so when it comes to buying a vehicle, assuming that you are taking out a loan to buy that vehicle like 50% of Americans do, you are going to want to look at how you can build in margin into that purchase so that you can strategically look at retiring other debt that may not have an underlying asset attached to it, and therefore most likely has a higher percentage rate. Now, when talking about debt consolidation or consolidating debt into one loan, I'm always very careful around this, because your bailout plan of combining that debt doesn't necessarily change the behavior that got you there in the first place. And so that's why you want to be really careful about consolidating debt, pulling things into one singular loan, because it makes you feel like you've done something, even though the debt's still there. And so why I say this is that so many people consolidate their loans. So many people look at ways to reduce their monthly payments without necessarily making progress on paying off that debt. So when looking at building in margin into your personal finances related to transportation, one thing you may want to consider is buying a vehicle that has a steady depreciation curve. So we've already talked about that, of course, but for example, you may want to look into a vehicle, maybe like a Honda. Let's say a 2019 Honda Accord Sport, and let's say that vehicle has a trade-in value of $22,000 and a retail value of $26,000. So let's assume that you're able to negotiate that vehicle and get it for trade-in value or below, and that you then have $4,000 that is in equity on that vehicle without surpassing or exceeding the actual book value of that vehicle, and most likely the market value, especially right now. So what you'll want to do from that point is look at that difference. Look at the $22,000 versus the $26,000 and look at that in comparison to your debt. So you may have a credit card that's at 17% interest, and you can take that and retire that debt by basically financing that vehicle for what it's actually worth. And so what you would do then is you would have that loan at a higher amount for your vehicle. You would take that amount and you would apply it to your credit card to pay down that credit card or pay it off. Now, what you want to be careful of is when you are trying to build your credit, you most likely, in most situations, you don't want to close that credit line. So you'll want to keep it open as long as you commit to not running that balance back up. And so you, like I said before, you want to be careful about the behavior and make sure that the behavior is actually changing so that you're not just giving yourself a bailout plan and then you go and charge up that credit card again. So the goal here is to build margin into your monthly payments, but at the same time, be mindful of getting that debt retired. So why I typically recommend this in certain people's financial plans is the fact that you have a definite period of time that you have that loan for related to the vehicle. So you may have a 3-year or 36-month loan. You may have a 6-year or 72-month loan. And so when you're looking at getting a loan on a vehicle, you have a finite period of time to pay that vehicle off. Whereas a credit card, you can pay the minimum balance for years to come, and it takes many years to pay it off. So for example, if you had that $22,000 Honda Accord that was financed at the typical loan term of 72 months at the typical rate of 5.5%, you would be paying about $359 per month on that vehicle. Now, let's assume that you have a $4,000 balance on that credit card at 17%, and assuming that you are paying 1% of the balance per month plus your minimum payment, you then will have about $100 for that credit card that you would be paying per month. The caveat or the challenge with that is the fact that that credit card is not based on a 6-year loan, not based on a 3-year loan. It is based on a 21-year loan. So basically, if you have that $4,000 balance, it will take you 21 years of paying that $100 payment in order to actually pay that off. And that's why I recommend that people look at consolidation carefully, not using a third party, not using someone to consolidate your loans, but actually look at how you can strategically look at your finances to see if it makes sense to roll something like a credit card into a car loan, therefore retiring the credit card and paying the entire amount off or in that term or less. So in addition to saving that money, that difference per month by rolling those two loans together and having a $425 payment per month instead of a $455 payment per month, you will also help to boost your credit. As long as you don't, cut off and close the card right away, you'll be boosting your credit because of your utilization to your actual card available balance. So you'll be able to then not only save from a standpoint of giving you a little bit more breathing room, not only put it on a schedule so that it's paid off in 6 years or less based on this scenario, but you also will be working to improve your credit if you end up using it in the future. Now, the second option comes down to looking at the depreciation curve for that vehicle, figuring out how you anticipate it depreciating over a year or maybe a year and a half, and looking at buying that vehicle at the trade-in value and then selling it a year later at the retail value. And why I say that is at that point, you're going to have a certain amount that you pay down on the principal because you have a 6-year loan and you're paying a larger portion of that loan payment to principal than you would be for like a credit card. But also from that point, you have built in margin from the get-go. And so the combination of the two, once you go to sell that vehicle, then can be utilized to pay down other debt. And of course, with that, you'll have to go get another car loan or save up for a car over that year and a half that you can pay cash for. But the purpose here is really to build in margin at the buy, at the purchase, but then over time, as you pay off that loan, watching the depreciation curve and being mindful of what the vehicle is worth, selling it so that you can recoup the funds and be able to pay off debt with those funds. Now, again, these two options are simple and pretty painless. And so most likely it won't change the behavior, especially overnight. And so what you want to be mindful of is so many people go out and they get a home equity line of credit. They go get a LOC of some kind, or they get a personal loan. They get all kinds of different instruments in order to live lifestyles that they really can't afford. And so my encouragement to you, my challenge to you, is to make sure that what you are purchasing you can actually afford, especially going forward. Now, let bygones be bygones. If you've gotten into debt in the past, just figure out a plan to get out of that debt and strategically look at your finances to figure out what components need to be involved in the debt payoff plan. But then from that point, look at how you need to live your lifestyle, based on what you can actually afford. So before pulling any kind of equity out of any kind of asset you have or getting a line of credit of some kind, be mindful of the plan to pay that back. Too many Americans today are living in a fantasy world where they're taking out loans for everything under the sun with no plan to pay it back. And what I would encourage you today to do is make sure that you have a plan for your debt. The debt that you've taken on, you have a plan to pay it off, and you have a plan that includes options so that if and when something happens, like a recession or something like that, you are not left in a place where you don't have options in order to either pay off that debt, to restructure that debt, or figure out a payment plan that works for you. So the goal with Margin is to continuously help you in building financial literacy, to make sure that that's something that people oftentimes don't like dealing with, their personal finances, is something that they have information in order to then be educated, in order to then make decisions that put them in a better position, so that we don't have a situation like 2008 happen where people had these revolving lines, had these credit cards and all kinds of different loans that overnight they couldn't pay for. And these organizations, these institutions, these banks basically called their loans and had many Americans going through some very trying times, whether through bankruptcy or some kind of restructuring or reorganizing these loans accordingly, and it left people in a place of just panic. And so that's why you want to be proactive with your personal finances. That's why you want to figure out options ahead of time rather than waiting for an emergency to happen. So my call to action today comes down to looking at your unsecured debt, then looking at the vehicle or vehicles you have and whether you actually have equity in those vehicles. So looking at the market and the book values of that vehicle, and then looking at, does it make sense to refinance or to buy your next vehicle with margin in mind, so that you can pay off those revolving lines that may be giving you an additional level or amount of exposure that is unnecessary. If this information is helpful to you, please do like, subscribe, and hit the notification bell so you're reminded to come back on a daily basis and improve in managing your personal finances. Thank you for your time. Enjoy your day. We'll see you back here tomorrow.